picture this. You're standing right there on 7th Avenue in Midtown Manhattan.
Right.
And you are looking up at this massive, just imposing glass fortress. And inside that building, supposedly, the most brilliant minds in global finance are moving billions of dollars across the planet.
Just with the click of a mouse.
Yeah, exactly. Just a click. And we are talking about a 158-year-old financial empire here. An institution that is so deeply embedded in the bedrock of the global economy that it actually survived the American Civil War.
Which is wild to think about.
It survived 2 world wars, it navigated the Great Depression, and it walked right through the dot-com bust without flinching.
Yeah, by all conventional metrics of power and capital, this place is invincible. It's the definition of a titan.
Right.
When you looked at Lehman Brothers from the outside, it possessed this kind of institutional gravity that makes it feel like it will outlast the country itself.
Absolutely.
The assumption was just that the people inside that glass fortress knew exactly what they were doing at all times.
But then, almost overnight, that invincible empire completely vanishes. Poof. Just gone.
Gone.
And it doesn't just quietly fade away, right? It collapses into itself, leaving behind this staggering $660 billion black hole.
Which is a number that's almost hard to comprehend.
It really is. And it threatens to pull the entire global economy down the drain with it. That scale of destruction alone is a wild, terrifying story. Yep. But the sources we are looking at today for this deep dive into the source material, they reveal an absolute slap-in-the-face contrast to all that Ivy League prestige.
Oh, yeah. The contrast is unbelievable.
Because as this titan was marching blindfolded toward the cliff, the only person who accurately predicted the exact granular mechanics of its death, the specific details, was a former frozen pork chop salesman.
Which, it genuinely sounds like a rejected Hollywood script.
It really does.
It feels way too contrived. But it is entirely factual, and it gets to the absolute core of why the financial system broke down.
So our mission today is very specific. We are ripping away the impenetrable Wall Street jargon. There are no academic snooze fests today.
None.
We are going to expose the raw, shocking absurdity of the 2008 financial collapse. We're looking at the greed, the blind arrogance, and the hidden ticking time bombs that nearly broke the world.
And my goal is to really break open the hood of this machine and show you the engine. Because the fall of Lehman Brothers wasn't some sudden, unforeseeable accident.
Right. It wasn't a natural disaster.
Exactly. It was a highly leveraged, incredibly complex system of incentives. And once we unpack the hidden mechanics of how these financial instruments actually functioned, the sheer scale of the disaster goes from being an abstract historical event to something deeply systematically terrifying.
Okay, let's unpack this by starting with our frozen meat maestro.
Yeah.
Because his journey into that glass fortress is the exact lens we need to understand the madness taking place inside.
Yeah, his background is crucial.
Right. Wall Street banks are famous for their pedigree. They ransacked the campuses of Harvard and Yale for the top 1% of the top 1%.
The absolute elite.
But our guy did not come from a country club. He literally started out driving a van around Massachusetts selling frozen meat.
Yeah, pounding the pavement.
And he was ruthlessly observant. He figured out early on that a full pork roast was way too big of a commitment for a single widow living alone.
Makes sense.
So instead of losing the sale, he'd pivot. He would hustle them into buying smaller 4-packs of pork chops.
Which shows he had a supreme understanding of the customer psychology.
Yeah.
He actually called himself the pork chop champion of the world. And while that sounds, worlds away from trading complex derivatives, the underlying skill is practically identical.
How so?
Well, he understood how to read people. He knew how to identify what they're willing to risk and how to structure a deal that appealed to their immediate needs.
But I'm looking at the chasm here between selling pork chops in Massachusetts and moving billions on a trading floor, and it's massive.
Oh, it's huge.
You don't just walk into the apex of global finance because you're a good salesman.
Yeah.
How does a guy with that background actually penetrate the inner sanctum of Lehman Brothers?
It was a brutal, years-long grind. He didn't just sneak in through the back door. He had to hustle relentlessly to bridge that gap.
Right.
He passed his Series 7 exam, which is the baseline requirement to become a stockbroker, and he started in the trenches.
Like cold calling.
Exactly. He worked in these shady, high-pressure bucket shops, the kind of places that rely entirely on aggressive cold calling to survive.
Wow.
And from there, he managed to claw his way up to Merrill Lynch, then Morgan Stanley, and he was rejected by the major Wall Street heavyweights more times than he could count.
Over 100 times,
Yeah.
according to the sources, right?
Yeah, over 100 times.
Right.
But eventually, that sheer tenacity landed him on the elite trading floor of Lehman Brothers. And this is the critical piece of the puzzle. His outsider status was actually his greatest weapon.
Because he hadn't been programmed by the same institutional machine as everyone else?
Exactly. The Ivy League recruits who filled the desks around him, they were trained to view the financial markets as a perfect mathematical equation.
Just numbers on a screen.
Right. If the computer model said a trade was safe, they believed it was safe. But he didn't have that blind faith in algorithms. He had a completely different psychological makeup, which he largely inherited from his father.
Yeah, the sources refer to his father as a perma-bear, which, in finance terms, means someone who is perpetually pessimistic, always expecting the market to crash.
Yeah, a perma-bear sees every single period of economic growth as an impending disaster. And his father took this worldview to the absolute extreme.
There's that crazy story in the text, right?
Oh, the Mercedes story. It's brilliant and so visceral.
Yeah.
So his father walks up to a pristine $100,000 Mercedes-Benz convertible.
Right.
He pulls out a golf club, a pitching wedge, specifically, and just calmly, methodically smashes the windshield, shatters the headlights, and destroys the taillights.
Just complete destruction.
Absolute calculated destruction of this beautiful machine.
I mean, that is a staggering level of intensity. What is the psychology behind taking a pitching wedge to a luxury car?
He was illustrating a deeply ingrained philosophy about the fragility of complex systems. His father was drilling into him that no matter how shiny and perfect something looks on the outside, no matter how much engineering went into it, it can be shattered in an instant.
Wow.
History always repeats itself, bubbles always burst, and someone somewhere in the system is always hiding a catastrophic mistake.
So you take that ingrained paranoia, that street-level understanding of human nature, and you put it on the trading floor at Lehman Brothers.
Yep.
And while the quants are looking at the glowing green numbers on their computer screens and trusting the flawless math, our guy is actively searching for the human error.
He's looking for the cracks.
Right. He's looking for the systemic delusion. And it pays off massively because that outsider perspective eventually allows him to make the firm nearly $50 million in a single day.
Which is an incredible feat. But to truly grasp what he saw on those screens that filled him with so much dread, we can't just look at the trading floor in 2008.
We have to go back.
If we connect this to the bigger picture, we have to rewind the tape. Because the foundation of this $660 billion catastrophe wasn't laid by evil bankers plotting in a boardroom. It was actually built on government good intentions.
Yeah, and let's pause here and be very clear with you listening. If we look objectively at the historical timeline laid out in the text, you see a chain reaction of policies spanning entirely different political eras.
Absolutely.
You had the Clinton administration heavily pushing for expanded homeownership in the 90s, and later on, sweeping deregulation and massive bailouts championed by Republicans.
Right.
The sources show us it wasn't about one side of the aisle. We were strictly neutral here, just reporting the facts from the source material. It was a systemic, multi-decade shift across the board.
That's right. If we focus purely on the mechanics of the policy, the initial domino was pushed in the 1990s with a very noble, understandable goal: homeownership for all.
Right.
The Clinton administration, operating through officials like Roberta Achtenberg, began exerting immense pressure on banks to lower their lending standards.
Tell people out.
Exactly. The objective was to open up the housing market to lower-income individuals and minority communities who had historically been completely shut out.
Which, on a human level, is a perfectly reasonable goal. You want to build the middle class.
Of course.
But the way they enforced it seems incredibly aggressive. The text notes that banks were essentially threatened with massive fines and regulatory backlash if they didn't start offering mortgages with zero cash down deposits.
Yeah, they were forcing banks to ignore their own risk assessment rules. They systematically dismantled the traditional barriers to entry.
Wow.
And structurally, it worked exactly as intended at first. It created an unprecedented influx of new homeowners in the market. Between 1993 and 1999 alone, 2 million new home buyers entered the system.
2 million.
Yeah. But this massive expansion of high-risk debt collided directly with another colossal structural change in 1999, which was the repeal of the Glass-Steagall Act.
Oh man, let's hover on Glass-Steagall because this is foundational to everything that happens next. This was a law written in 1933, right in the smoking wreckage of the Great Depression.
Right. The authors of that law looked at the 1929 crash and realized that when you mix a commercial bank with an investment bank, you create a literal powder keg.
A recipe for disaster.
Exactly. So for 60 years, Glass-Steagall acted as a structural firewall. It strictly separated the boring, everyday commercial banks where everyday people deposit their paychecks and keep their retirement savings from the high-rolling investment banks on Wall Street that speculate and take massive risks.
Well, they couldn't touch your checking account.
Precisely. It ensured that a bad day on the trading floor couldn't wipe out the checking accounts of millions of citizens.
But the financial giants hated that firewall. They lobbied fiercely to tear it down, and in 1999, it gets repealed. This legally allows the creation of massive financial conglomerates like Citigroup.
To put it in perspective, imagine a casino.
Okay.
For 60 years, there was a velvet rope separating the high-stakes blackjack tables from the vault where all the casino employees kept their personal life savings.
Right.
The gamblers could only bet the chips they brought to the table. But when Glass-Steagall was repealed, they didn't just remove the velvet rope, they literally gave the high rollers the keys to the employee vault.
So basically, we took the velvet rope away and let the high-stakes blackjack dealers play with everyone's boring retirement accounts.
Exactly. And as the sources point out, our guy's father was watching this historic repeal happen on television, and he is practically screaming at the screen.
He knew it was coming.
He sees them setting up the exact conditions for the next Great Depression because he recognized the mechanical hazard. The moment that firewall drops, the massive cash reserves of the commercial banks flood straight into the investment banking casino.
It's just a tidal wave of cash.
A tidal wave. The high rollers suddenly have access to an almost limitless supply of depositors' money to back their increasingly aggressive bets. One wrong move now has the potential to contaminate the entire economy.
Wow.
And this massive influx of casino capital perfectly collides with a sudden microscopic drop in interest rates.
The timing is just incredible. Right after the firewall comes down, we hit the early 2000s. The dot-com bubble bursts. Giant tech companies completely evaporate.
Yeah, a tech got decimated.
The sources highlight Cisco as a prime example. They lose $400 billion in value in a matter of months. I mean, they had a price-to-earnings ratio of 160 times. It was insane.
Your bubble.
And so the economy is teetering on the edge of a recession. So the Federal Reserve Chairman at the time, Alan Greenspan, he hits the panic button. He slashes interest rates from 6% all the way down to a microscopic 1%.
They effectively made borrowing money free.
But let me play devil's advocate here for a second. Cheap money sounds fantastic for the average consumer.
Sure it does.
Cheap TVs, affordable cars, 1% mortgages, it sounds like a utopia. If money is that cheap and everyone is borrowing, why didn't this immediately trigger massive hyperinflation? Like, why didn't the price of bread skyrocket to $10 a loaf?
That is the trillion-dollar question right there. And the answer lies in a massive geopolitical shift, the Chinese dragon.
Oh, right.
At the exact moment Greenspan is flooding the U.S. with cheap money, China is entering a period of hyper-industrialization. They are flooding the United States with dirt-cheap consumer goods.
Right. Everything at the big box stores.
Exactly.
Yeah.
So while Americans have more borrowed cash than ever, the cost of the things they are buying at Walmart and Home Depot is actually dropping. The influx of cheap Chinese goods perfectly masked the inflation that should have been destroying the American dollar.
But the mechanics of this get even wilder. Because China isn't just hoarding those American dollars under a mattress.
No, they took all those U.S. dollars they were raking in and they turned around and bought hundreds of billions of dollars in U.S. Treasury bonds.
Just let me get this straight.
Right.
Americans buy cheap Chinese goods with borrowed money.
Yes.
China takes that money and lends it right back to the United States government by buying bonds.
Yes.
They are literally lending America its own money back.
It was a perfect cyclical illusion. By buying up U.S. debt on a massive scale, China was effectively subsidizing America's borrowing costs. This global loop is what allowed Greenspan to keep interest rates artificially low for years. It was a positive feedback loop built entirely on a foundation of debt.
Okay, but again, if the system is stable and the goods are cheap, where does the toxicity come in? Why does a 1% interest rate break Wall Street?
Because of the unintended consequence on yield. When the Federal Reserve drops rates to 1%, traditional savings accounts and safe government bonds pay absolutely nothing in interest.
Right, you get pennies.
If you are a massive pension fund managing the retirement accounts of teachers and firefighters, you need a certain percentage of return just to meet your obligations.
You have to grow the money.
You are starving for yield. Wall Street looked at this global desperation and realized they had a unique opportunity. They needed to invent a brand new financial product.
Something totally new.
Something that looked as safe as a U.S. Treasury bond, but offered the high returns of a risky bet.
And enter the CDO, the collateralized debt obligation. This is where the Wall Street alchemy begins. This is where they literally engineered a mathematical magic trick to turn absolute trash into AAA gold.
Alchemy is the only word for it. Let's break down exactly how a CDO is manufactured because it's wild.
Please do.
It starts on the ground level. A mortgage broker out in California lends $300,000 to a person with no job, no assets, and terrible credit.
Sounds like a terrible idea.
On its own, that single mortgage is incredibly high risk. It is financial trash. But Wall Street banks, like Lehman Brothers, would swoop in and buy thousands of these crappy mortgages.
Okay.
They would bundle them all together into one massive pool. Then they would slice that giant pool up into different layers or tranches.
But wait, slicing up a pie made of rotten apples just gives you smaller pieces of rotten apples.
Right.
Investors aren't idiots. A massive pension fund in Germany isn't going to buy a slice if they know it's full of terrible loans. How do they convince the global market that this trash is actually gold?
That is where the rating agencies come in. Entities like Moody's, Standard & Poor's, and Fitch.
The referees.
For decades, these agencies were the gold standard, impartial referees of the financial system. They evaluated corporate bonds and slapped a rating on them. But Wall Street brought these new, complex CDOs to the agencies, and the sources reveal an absolutely staggering conflict of interest at the heart of this process.
Glad it happened.
The rating agencies were essentially being paid by the banks whose products they were rating, and they were collecting massive fees up to $600,000 per deal.
$600,000 just to rate one deal. I mean, it's like a health inspector slapping a pristine grade A sticker on a box of blatantly rotten meat entirely because the slaughterhouse just slipping the keys to a brand new Ferrari.
That's exactly what it was. And let's pull that thread even further. It's not just a bribe, it's a structural necessity for the bank.
How so?
If Lehman Brothers can get that grade A sticker, which in finance is a AAA rating, it fundamentally changes the nature of the asset. A AAA rating means the asset is considered virtually risk-free.
Right.
It is equated to the safety of a U.S. government bond. So the rating agencies, blinded by these massive fees, built deeply flawed mathematical models that assumed that because these thousands of terrible loans were geographically diverse, they wouldn't all default at the same time.
So they just rubber-stamped it.
They rubber-stamped toxic debt as AAA.
Which unleashes a global tragedy. Because once that AAA stamp is on the paperwork, the doors swing wide open. It's not just hedge funds and gamblers buying these things anymore.
No, that stamp was the golden ticket. It allowed these toxic bonds to be sold to highly conservative institutions, school boards, municipal governments, European commercial banks, and massive retirement accounts all over the world.
Everywhere.
A regional bank in rural Germany or a pension fund manager in Japan would look at the prospectus, see the AAA rating from Moody's, and say, oh, this is a perfectly safe conservative investment for our retirees.
Wow.
They had absolutely no idea they were actually buying bundled, high-risk, subprime mortgages originating from the deserts of Nevada and California.
Here's where it gets really interesting, because I want to zoom in on those actual mortgages.
Let's do it.
We hear the word subprime all the time, but the numbers and anecdotes the sources provide are just visceral. Let's look at the ground zero of this housing boom. In Stockton, California, housing prices surged 50% in a shockingly short period.
50%.
And this brings us to the most infamous acronym of the era, the NIJA loan.
No income, no job, no assets.
I am looking at the sheer logistics of this, and it boggles the mind. The sources talk about brokers out in California writing $300,000 checks to people who were literally homeless.
Yeah, it's hard to believe.
They were forcing illiterate people to sign complex financial contracts they couldn't even read. If you lend $350,000 to a guy living in a tent, you know with absolute certainty he cannot pay you back.
Of course.
Why on earth would a broker willingly write that loan?
Because the entire incentive structure had been completely decoupled from consequence. The broker didn't care if the borrower defaulted because the broker didn't hold the risk.
Right.
This was the golden age of the shadow banks, massive mortgage originators like New Century and Countrywide. They operated on an originate-to-distribute model.
Which means what exactly?
It means the broker's only objective was to get the signature on the paper. The minute the illiterate guy signed the contract, the broker collected a massive upfront commission. Then, before the ink was even dry, the shadow bank bundled that loan and sold it upstream to Wall Street giants like Lehman Brothers.
So the broker is essentially just a hitman who gets paid up front for the body, and Lehman Brothers is standing at the end of the line, happily buying the bodies as fast as they can produce them.
They weren't just buying them, they were addicted to them. Lehman Brothers was making tens of millions of dollars in fees every single time they bought a massive pool of these loans, packaged them into CDOs, and sold them off to the global market.
Just printing money.
They were churning out these securitizations on an industrial scale. The profits were so euphoric, so immediate, that the executives completely abandoned fundamental risk management.
They just operated under the delusion that housing prices would go up forever.
That was the foundational myth holding the entire architecture together. The mantra repeated in boardrooms across Wall Street was, the U.S. housing market has never dropped more than 5% in any year since the Great Depression.
They actually believe that.
They genuinely believed that the collateral, the physical house itself, would always appreciate in value. Their logic was, even if the non-INJ borrower defaults on day one, it doesn't matter. The bank can just foreclose, take the house, sell it in a booming market for a profit, and everyone still makes money.
But the guys at Lehman we talked about earlier, the distressed debt guys, the guys who actually understand what happens when a system breaks, they saw the ticking time bomb hidden deep inside the paperwork of these NINJ loans.
Yes, they did.
They saw the teaser rate.
And the teaser rate is the mechanical trigger for the entire global collapse.
I mean, I'm looking at the math on a NINJ loan, and if you have zero income, how does the bank expect you to make even a single monthly payment?
Exactly.
There had to be some sort of structural gimmick keeping the front end of this loan afloat so the borrower wouldn't default before the ink was dry.
And that gimmick was the adjustable rate mortgage, the ARM. These mortgages were structured with a bait and switch.
Okay.
They started with an artificially low teaser interest rate, often around 1%. So for a $300,000 home, the monthly payment might be a very manageable $500.
Which sounds doable.
The borrower, even if they are scraping by, can manage that for a little while. But the fine print dictated that after a honeymoon period of a year or two, the interest rate would automatically reset to a normal, much higher market rate.
So that $500 monthly payment doesn't just creep up slowly. It suddenly skyrockets to $2,500.
Overnight. And the borrower, who never had the income to begin with, is instantly bankrupted.
Wow.
Now, the risk managers at Lehman, brilliant minds like Mike Gelband and Larry McCarthy, they didn't just guess that this was bad. They pulled the raw data. They mapped out the entire mortgage market, and they could see the exact dates these teaser rates were scheduled to reset across the country.
They could literally map out the timeline of the impending tsunami.
They knew with absolute certainty that millions of people were going to simultaneously default on their mortgages. It wasn't speculation, it was a mathematical certainty written right into the contracts.
It was already set in stone.
Gelband actually took this terrifying data directly to the executive committee. He laid it out for them. He showed them that a staggering 1/3 of all mortgages issued in the country were of this toxic variety, and that the upcoming wave of resets would detonate the market and destroy the value of the CDOs Lehman was hoarding.
Okay, if it is a mathematical certainty, and the top risk managers in your firm are laying out the data on the boardroom table, why isn't the entire Lehman executive suite pulling the fire alarm?
You'd think they would.
Right. Why wouldn't they immediately shut down the origination machine?
This brings us to the core thesis of the source material, the colossal failure of common sense. You have to look at the perverse incentive structure governing the executives.
The bonuses.
The men running the firm, from the 31st floor CEO Dick Fuld and President Joe Gregory, were being compensated based on short-term revenue. The CDO machine was currently printing cash. They were taking home tens of millions of dollars in annual bonuses right now.
Wow.
To acknowledge the risk and stop the machine meant voluntarily stopping their own massive bonuses.
So it's Pure, unadulterated greed,
Yeah.
blinding them to a cliff they're driving right toward.
Greed, heavily insulated by willful ignorance.
Yeah.
They convinced themselves that the subprime problem was, quote-unquote, contained.
Contains.
They thought they were smarter than the market. But the distressed debt guys realized that the executives driving the bus were steering it straight into the abyss, and no amount of data was going to make them hit the brakes.
So they were trapped.
So they were faced with a massive dilemma. If you see your own firm driving off a cliff, what do?
You brace for impact. You find a way to protect your own book. And they did this by effectively going rogue. They started betting against their own firm's market position.
Yes. They utilized a highly complex, deeply controversial financial instrument called the credit default swap, or CDS.
Let's break down the mechanics of the CDS, because on its face it sounds completely insane.
It does.
The sources show the team using these swaps to buy what they call death insurance on massive home-building corporations like Beazer Homes. But the catch is, Lehman didn't actually own any stock or bonds in Beazer Homes. They had no underlying financial interest in the company whatsoever.
And that is the defining feature of a credit default swap. It allowed an investor to place a massive financial bet that a specific company or a specific pool of mortgages would fail, even if they had no ownership stake in the underlying asset.
I'm trying to map this onto the real world.
Yeah.
That would be like me taking out a massive life insurance policy on a total stranger I saw walking down the street, and when they die, I get $1 billion.
Yes.
How does that not create a massive incentive for me to push them into traffic? That sounds wildly illegal.
Well, for a very long period of financial history, it essentially was illegal, precisely because of the moral hazard you just described.
Makes sense.
Back in the 19th century, speculators used to buy insurance on commercial whaling ships they didn't even own. And miraculously, those specific ships started mysteriously sinking at sea.
Shocking.
Right. So the government recognized the danger of allowing people to profit from the destruction of property they didn't own, so they effectively banned the practice. But in the year 2000, through a piece of legislation called the Commodity Futures Modernization Act, Wall Street lobbied aggressively to deregulate these modern derivatives.
They just changed the rules.
Suddenly, it became perfectly legal to buy fire insurance on your neighbor's house and then just sit back and wait for it to burn down.
And Wall Street took this deregulated concept and turned it into a $70 trillion shadow casino.
$70 trillion. It is a number so large it loses meaning. That was the estimated notional value of side bets, completely unregulated, hiding in the dark corners of the financial system.
Unbelievable.
And this rogue team used these instruments to effectively short the housing market. But they didn't stop there. They also utilized their specific expertise in distressed debt to pull off incredibly lucrative trades.
Oh, like the Delta trade.
The sources detail a legendary play involving bankrupt Delta Airlines.
Okay, let's explore how a distressed debt trade actually works. Because the book says they bought Delta debt at 12 cents on the dollar and sold it at 55 cents, making $250 million.
Right.
How do you make $250 million off a company that is bankrupt?
It requires an incredibly cold analytical view of a company's wreckage. When a massive company like Delta files for bankruptcy, the market panics.
Nice.
The debt the company owes plummet in value because most investors assume the company will be liquidated and they'll get absolutely nothing. The debt trades at pennies on the dollar, in this case, 12 cents.
Okay.
But these distressed debt analysts looked closely at Delta's actual underlying assets. They looked at the physical airplanes, the lucrative flight routes, the gates at major airports.
The actual hard assets.
Yeah, exactly. They realized that in a bankruptcy restructuring, those assets still held massive value. They deduced that the debt was vastly underpriced by the panicked market.
So they buy massive blocks of this debt at the absolute bottom.
They buy the claims at 12 cents. Then, as Delta navigates the bankruptcy courts, it becomes clear they aren't going to liquidate, they are going to reorganize and survive.
And the price goes up.
The market realizes the debt actually has value, and the price surges up to 55 cents. The team executes the trade perfectly.
They make $250 million in profit for Lehman Brothers in a single day.
One day,
You would think Dick Fuld, the CEO, would carry them out of the building on his shoulders. That is a historic win.
and yet Dick Fuld never even came down to the trading floor to congratulate them.
Are you serious?
He was completely physically and psychologically isolated in his ivory tower on the 31st floor. He had surrounded himself with yes men. He was so detached from the actual mechanics of trading, so utterly obsessed with competing against rival banks like Goldman Sachs in the CDO market, that he didn't care about the brilliant risk mitigation happening right under his nose.
Which brings us to the core of Lehman's lethal illusion. Because making $250 million is fantastic.
Yeah.
But when you look at the broader math of Lehman's balance sheet, it is a microscopic drop in a massive toxic bucket.
Right?
Let's talk about leverage, because this is where the math becomes truly terrifying. The sources state that Lehman was leveraged at 44-1.
Yeah, and what's fascinating here is how leverage is one of those clinical finance terms that hides immense danger.
So it sounds like a strategy.
But it is, quite simply, borrowed money. To understand how precarious Lehman's position was, we have to look at the actual numbers. Lehman Brothers only had about $15 billion of their own actual money, their equity capital.
Okay, $15 billion.
But they used that $15 billion as a foundation to borrow massively, inflating their balance sheet to hold a $660 billion empire of assets.
44-1. That means for every one single dollar they actually owned, they borrowed $44 to gamble with in the market.
That's the math.
I'm trying to picture that level of instability. It's like driving an 18-wheeler down the highway at 140 miles per hour, balancing a glass of water on the dashboard and telling yourself, as long as I don't hit a single pebble, I am perfectly safe.
That captures the sheer recklessness of it perfectly. Let's do the brutal math on 44-1 leverage. When you are leveraged that highly, your margin for error is virtually non-existent.
It has to be.
If the value of your $660 billion asset portfolio drops by just a microscopic 2.2%.
Wait, 2.2%?
Just 2.2%. Your entire $15 billion in equity is completely wiped out. You are at zero. You are bankrupt. You cease to exist.
A 2.2% drop in a housing market that they themselves have flooded with NINJ loans. And the risk guys are sitting downstairs staring at the interest rate reset data, knowing with absolute certainty that the market is going to drop significantly more than 2%.
They were operating in a state of sheer panic. But the executives on the 31st floor, Fond and Gregory, weren't just ignoring the pebble on the highway. They were actively pushing the accelerator harder.
How is that even possible?
At the exact moment they should have been deleveraging, which means selling off assets, taking a small loss, and using the cash to pay down their massive debt. They went the opposite direction.
You've got to be kidding me.
They started borrowing even more money to buy massive commercial real estate properties. The most egregious example from the text is when they bought a company called Archstone Smith for $22 billion at the absolute peak of the real estate bubble.
I don't understand the logic. If you know the residential housing market is toxic, why on earth would you double down on commercial real estate?
Because they believed in a theory called decoupling. They convinced themselves that even if the U.S. subprime residential market crashed, the commercial real estate market and global economies would somehow magically stay afloat.
They thought they were completely separate things.
They thought the sectors were disconnected. It was pure, unadulterated hubris. And to make matters worse, they weren't just taking bad risks. They were actively hiding the true extent of their toxic debt from the public.
Right, the accounting magic. The sources bring up an accounting loophole called Rule 140 and something about off-balance sheet entities. How do you hide billions of dollars in debt when you are a publicly traded company audited by the SEC?
You do it by creating legal ghosts. Lehman utilized entities known as QSPEs, qualifying special purpose entities.
What are those?
These were essentially shell trusts set up in offshore havens like the Cayman Islands. Under the incredibly lax accounting rules at the time, specifically Rule 140, Lehman could take a massive portfolio of toxic depreciating CDOs and sell them to this offshore trust.
But the trust doesn't have any money. How does it buy the debt?
The trust issues short-term commercial paper to pay for the assets, and Lehman Brothers provides a liquidity guarantee on that paper.
Ah, I see.
So technically, on paper, Lehman has sold the asset. The debt comes off their official balance sheet. So when the SEC and their investors look at their quarterly reports, Lehman looks significantly less leveraged than they actually are.
But they still hold the risk.
Exactly. In reality, Lehman retains all the actual risk. If the assets go bad, the guarantee kicks in and the debt comes boomeranging right back to Lehman. It was an accounting sleight of hand that required them to hold only 3% capital against those offshore assets.
Just 3%.
It allowed them to keep borrowing and keep pretending they were highly profitable.
But eventually, gravity takes over. By the summer of 2008, the dominoes are seriously starting to wobble. The subprime market is cracking. Bear Stearns, one of their major rivals, has already imploded and been swallowed by J.P. Morgan Chase in a government-backed rescue.
Things were getting really dark.
The panic inside Lehman reaches a boiling point. The fixed income generals, the guys on the ground who actually understand the lethal math, know they are staring into the abyss, which leads to this incredible dramatic scene in the book, The Bloodless Coup.
It was a literal mutiny. In June of 2008, 12 top executives from the fixed income division held a secret dinner at a private club in New York called the Red Lion.
Like a movie.
These were battle-tested generals who recognized that the firm was weeks away from death. They decided they had to stage a coup to save the institution. They banded together and successfully forced the board to oust President Joe Gregory, who had been Fold's loyal enforcer and the architect of the massive real estate binge.
They pushed him out.
And they replaced him with a highly respected trader named Bart McDade.
So they chop off the right hand, but they can't get rid of the king. Dick Fold survives the coup and remains CEO.
Fold survived, but his power was severely weakened, and he was more isolated than ever. And this is where his ultimate psychological hubris truly seals Lehman's fate. The market is collapsing all around them. Everyone on Wall Street knows Lehman is the next domino to fall. Their stock price is plummeting. They are bleeding cash.
It's over.
But Fold genuinely deeply believed that Lehman Brothers was too important to the fabric of the American economy to be allowed to die.
He honestly thought the U.S. government would just step in and hand him a bailout, just like they did for Bear Stearns.
He was utterly convinced of it. He believed the Treasury Department would never risk the systemic shock of letting a primary dealer fail. So, when an actual viable lifeline was thrown to him, his ego couldn't accept it.
What was the lifeline?
The Korean Development Bank approached Lehman and offered to buy the firm for $23 a share. At that point, it was an incredibly generous offer.
Wow.
It would have saved the firm, saved the jobs of his employees, and prevented a global catastrophe.
But Fold rejects it. The ship is literally scraping against the iceberg. Water is pouring into the engine room. Another boat pulls up and throws you a lifeline, and you complain that the roast isn't made of silk.
Because Fold was still valuing his firm based on the delusion of 2006 prices. He looked at his massive portfolio of toxic real estate and still believed it was worth top dollar.
He couldn't let it go.
He thought $23 a share was an insult. He later rejected an even lower offer. He was playing an incredibly dangerous game of chicken with the global financial system, assuming that the U.S. Treasury Secretary, Hank Paulson, would blink first and hand him a taxpayer-funded rescue.
But Hank Paulson did not blink. And that brings us to the climax of the disaster, September 15th, 2008, the day the invincible empire finally died.
Paulson drew a hard line in the sand. There was massive political backlash brewing over Wall Street bailouts, and Paulson decided he needed to make an example out of someone to prove that the era of government rescues was over.
He chose Lehman.
He refused to use government money to save Lehman. He corralled the heads of the other major banks in a room and told them they had to figure out a private solution. When they couldn't, he forced Lehman Brothers to file for Chapter 11 bankruptcy.
And just like that,
the 158-year-old titan was vaporized. $660 billion of debt was violently thrown into the bankruptcy courts.
they let one guy drown in the pool to teach the rest of the market a lesson about personal responsibility. But what they utterly failed to realize was that the drowning man was chained to the legs of every other swimmer in the pool.
That is exactly the systemic failure of the regulators. Paulson and the Treasury Department wildly underestimated the interconnected web of credit default swaps. Remember that $70 trillion shadow casino we talked about earlier?
Fire insurance on the neighbor's house?
Precisely. Lehman Brothers wasn't just holding bad mortgages. They were a central counterparty to thousands of complex derivative trades across the globe.
Oh, no.
When Lehman died, it triggered global margin calls on all those swaps. Thousands of institutions had placed bets with or against Lehman. Suddenly, Lehman defaults on its obligations. Panic spreads instantly.
Complete chaos.
No one knew who owed what, but every bank knew they didn't have the cash to pay if the bets went against them. The trust in the system evaporated overnight. And the most shocking consequence happened just 24 hours after Lehman declared bankruptcy. AIG, the world's largest insurance company, effectively imploded.
Wait, 24 hours. How does the bankruptcy of an investment bank instantly destroy the largest insurance company on the planet?
Because AIG had spent years writing billions of dollars in credit default swaps, essentially providing the insurance for the toxic CDOs that Lehman and others had created.
They were the ones selling the insurance.
Yes. AIG collected the premiums, assuming housing would never crash. When Lehman collapsed, the value of the CDOs completely tanked, and the massive institutions holding those swaps demanded their insurance payouts from AIG.
And AIG didn't have the money.
AIG was suddenly on the hook for tens of billions of dollars. They simply didn't have the cash reserves to pay the claims. They were instantly, catastrophically insolvent.
So by letting Lehman die out of a principled desire to enforce market discipline, the government accidentally unleashed a systemic terror that froze the entire global credit market.
The credit markets froze solid. We see this measured in something called the TED spread.
The what?
The TED spread. It's essentially a thermometer for fear in the banking system. It measures the difference between the interest rate banks charge each other for short-term loans and the supposedly risk-free rate of U.S. Treasury bills.
Okay.
Normally, that gap is incredibly small. But when Lehman fell, the TED spread shot up to levels not seen since the 1987 crash. Banks completely stopped lending money to each other because they were terrified. The bank across the street was secretly hiding Lehman-style toxic debt.
So the money just stops moving.
The financial plumbing of the world clogged instantly. Corporations couldn't get short-term loans to make payroll. The entire economy was grinding to a halt.
Which forced the U.S. government to do exactly what they had tried so hard to avoid. They had to execute the massive $700 billion TARP bailout. They effectively had to nationalize huge swaths of the banking system and pump billions into AIG just to prevent a second Great Depression.
They sacrificed Lehman to save taxpayer money, and the resulting contagion cost the world trillions. It was the ultimate tragic miscalculation.
So what does this all mean for us? When we pull back and look at the whole incredible story, we went from a government aggressively pushing well-intentioned homeownership to the complete removal of a 60-year-old regulatory firewall.
Yeah, piece by piece.
We watched a positive feedback loop of cheap money from China fuel a frenzy where Wall Street alchemists bundled trash mortgages into AAA gold. We saw homeless people handed $300,000 loans they couldn't read, and we saw rogue traders placing massive bets in a $70 trillion shadow casino.
It's just staggering when you lay it all out.
And it all detonated because a CEO, isolated in an ivory tower, believed his 44-to-1 leveraged empire was simply too big to fail.
It means that the people we assume are in control, the experts driving the global economy, are often driving the bus completely blindfolded.
Yeah.
And the consequences are painfully real. This wasn't just about glowing numbers flashing red on a Bloomberg terminal. This crisis evaporated millions of jobs. It decimated pension funds that people had worked their entire lives to build, and it caused millions of families to lose their homes to foreclosure.
Real people suffered.
It was a colossal failure of common sense, driven by an incentive structure that rewarded short-term greed and willful ignorance over long-term survival.
But we supposedly paid trillions of dollars to learn the lesson of Lehman Brothers. We bailed out the system, the regulators patched the most obvious holes, we passed new laws, and politicians promised us never again.
But if we look closely at the source material, it leaves us with a deeply chilling fact: that $70 trillion credit default swap market.
Yeah.
The fundamental illusion of taking high-risk debt and packaging it into complex, seemingly risk-free mathematical derivatives, that hasn't disappeared.
Wait, it hasn't?
No. The specific names of the products have changed. The acronyms are different, but the underlying mechanics of shifting risk into the shadows have largely just been postponed and rebranded.
Which brings us back to where we started. We look at these massive glass fortresses, and we expect the finance happening inside to be precise, clean, and mathematically sound. But the reality is incredibly murky, constantly driven by human flaws, perverse incentives, and systemic delusion. So we leave you with this final thought. Right now, somewhere on Wall Street, a new, incredibly complex mathematical derivative is being traded in the shadows. If an invincible 158-year-old titan can be completely vaporized overnight by its own arrogance, are we actually any safer today, or are we just waiting for the next interest rate reset?